Welcome to episode 2 of our educational series on passive real estate investing basics. Be sure to watch our other series on 1031 exchanges and real estate taxation basics. We also encourage you to read our book, How to Retire from Being a Landlord, which you can order for free on our website or on Amazon.
In this module, we will continue our discussion from episode 1 regarding metrics for comparing rental property performance. Specifically, we'll explain the difference between net operating income and yield on equity. Let me point out that this discussion is intended to apply to all real estate investing and is not specific to private placements. So, let's start with net operating income, or NOI. For any given property, its NOI equals 12 months of revenues minus operating expenses for the property. NOI is intended to be owner agnostic, meaning that the NOI of a property should be the same regardless of who owns it. This metric allows a potential buyer to compare properties on an apples-to-apples basis.
As we mentioned in the last episode, when an investor expects to buy a property at a particular cap rate, she'll divide the property's projected net operating income by a target cap rate to determine her offer price. Of course, the actual yield on your cash investment in a property depends on the circumstances that are unique to you. For example, you may borrow 50% of the purchase price of a property with an interest-only loan at 4%. As a result, you would have an annual debt expense equal to 2% of your purchase price. This is an expense that's unique to you. You may also have an ownership structure for this investment that generates different costs than another investor might have.
In addition, the NOI of a property would not tell you how much potential income you would expect to receive as a percentage of your cash investment. And NOI by itself does not help you compare a potential investment's cash flow with the rental property you are selling. Therefore, when comparing your current rental property with potential replacements, we recommend that you will rely on a more specific metric known as yield on equity. So how do we get from NOI to yield on equity?
So to get from NOI to yield on equity, we have to make a few adjustments to the formula. In the numerator, we deduct the cost of servicing the loan and other expenses related to the ownership entity. For the denominator, we use current equity rather than the property value. Simply put, to get to yield on equity, you calculate how much money you put in your pocket each year before taxes and divide that amount by the current equity in your property. It's common for investors to think of their net rental income as a percentage of the price they paid for the property, say 20 years ago, but that's a mistake. You should think of your current yield as a percent of your property's current value, and more specifically, your property's current equity. It's not relevant that your property generates an 8% yield on your original purchase price if your equity has tripled.
The key takeaway here is that knowing the yield on equity of both your rental property and a replacement property will allow you to make a true apples-to-apples comparison of cash flow.
Thanks for watching. Be sure to watch our other education modules and visit our website at 1031capitalsolutions.com.